For the last 10 or 15 years, in the U.S. economy, it required greater and greater amounts of credit in order to generate $1 of additional output. People were buying automobiles, notes for 7, 8 years for automobiles that would not be worth the loan balance in 5 years. That would probably not last 7 or 8 years. Idea was that you put it out there and then they buy a car, and the financing would come through. The lender would borrow in the commercial paper market at 1% or 1.5%. The Greenspan Fed kept credit very, very easy by keeping interest rates lower than made any sense. And so you also got homes financed 5% down, 3% down. Which means that a person really didn't have to put in anything into a home in order to be an owner. That is, what does it mean to own a home when you don't put a down payment? I mean, why is that ownership? So, the standard way, and the way in most other countries, is that you put down a substantial amount of savings, that is to indicate that you have a stake in the home, and that it's something you want to use. Well, if you buy a home with nothing down or with 5% down, you're either poor or you're a speculator. I mean, you want to get the home in your name. If the value goes up and you haven't put anything up, then you can sell it. You buy it for $200,000, that is, you borrow $190 or $195, and then it goes to $240. You sell it, and $40,000 is yours, and you haven't done anything. You haven't worked. You haven't earned anything. You've just been a smart gambler. Well, it turns out most people are dumb gamblers in this way. So far, homes, on average in the U.S., from the peak a couple of years ago, have dropped 20% in value, and may drop another 15 or 20%. We don't know. There are more homes than people are willing to work and put the result of their effort into a payment on the home. There are more automobiles than there are drivers among people in the upper half of the income level in the U.S. There's too many of a lot of stuff. And so what you would normally do is have a contraction of output until the unused inventories are purchased by people. The difficulty is that the U.S. is so hooked on credit that the retail industry will go into a deep, deep recession. And many stores will close, and many people will be laid off. And the same thing at restaurants. And the automobile industry is folding up. And we don't need to produce another house in this country for years. So the trend of the economy, and anybody who watched my investment videos knows that I called the U.S. recession in September of '07. And in my video in June of '08, I suggested that we were in a world recession, going into a world recession. So our export industries will be doing poorly, and retail and other consumer goods will be doing poorly. And so what has been the government response? Well, Paulson, the Secretary of the Treasury, is responsible in part for inducing the SEC to permit investment banks to lend out $40 for every $1 of capital. Now, commercial banks can't do that because they're regulated and they have to put up more capital. They have to keep more capital in reserve. They have deposit insurance. He tried to do it when Arthur Levitt was the head of the SEC in 2000, failed, but won in 2004. So this is a man who is to a great extent responsible for the excess credit and for the excess lending that led to mortgage-backed securities representing loans to people who can't pay, and representing loan balances that exceed the market value of homes. So the response of the U.S. government and the Fed was to say, we're not going into recession. Well, when you go into recession, even if your house was overpriced when you bought it, you also will have declining income. You may feel the need to save more, and you may get laid off. And so if the automobile industry can't produce cars, then the grocery stores and bars in the neighborhood of automobile plants and accessory plants and retail outlets will go down too, because they can only sell to people who are actually doing something economically productive. Now, Bernanke at the Fed also said, you know, the economy is growing and we have some worries with inflation. As I told you, in my investment video, I thought this was a phony worry because of the fact that we were going into recession and the world was too. Therefore, commodity prices would go down, and we didn't have wage pressure. We had some stuff going up in price, but not a general increase in inflation. And now suddenly, when things are bad, what Paulson thinks to do is to bail out the industry that he prospered so excessively in. And this is what Paul McCulley of PIMCO calls serial ad hocery. That is, hey, today we'll save Bear Stearns. And in reality, save J.P. Morgan, who apparently was a counterparty in a number of derivatives that would go under with Bear Stearns. So by pretending that the J.P. Morgan was helping to bail out Bear Stearns, the Fed was able to bail out J.P. Morgan. And then what you do is you invest in major banks, Morgan, Wells, Bank of America, and you do it without auditing these companies, without knowing what they have on their books. Morgan and Goldman and less Bank of America, but Citibank, these are trading houses. I mean, they are banks. They do have banks and deposits, but they're really hedge funds disguised as commercial banks. I'll finish this in part 4.